So you've got $1,000 or even $500, but you have no idea how to invest it. Well, stay tuned because that video is today. Getting started in investing can be a very intimidating process, and I know that from experience. There are so many different investment products to choose from, with the most common ones being mutual funds, stocks, bonds, or some combination of all of those things, to even more exotic investment instruments where you don't even know what they're representing. I recently did a video where I explained why it's generally a bad idea to invest in mutual funds, and you can find that video somewhere up here or down in the description below, so go check that out after watching this video. I think the link's right there. In the realm of investing in individual stocks, there are thousands of companies to choose from, and with just $500 or $1,000 to get started, you will not be able to afford most of those stocks, and more importantly, even if you're just buying one or two shares, you're not going to be able to buy that many different companies, which means you'll have a very high risk and non-diversified investment portfolio if you decide to go that route. But don't get discouraged, because with $1,000 or even just $500, you can get started investing and you can have a very diversified portfolio that is very low cost to hold. And I'm going to show you how to do that in just a minute. As part owner of a company, by purchasing shares of stock, you will participate in the increase or the decrease in that company's valuation, as indicated by changes in the company's stock price. But there are funds that invest in diversified portfolios of stocks, typically tracking specific stock market index products, and if you purchase a share of that fund, you will therefore own a portion of the fund's holdings. And if the fund's holdings are a diversified portfolio of stocks, by owning a share of that fund, you will therefore have exposure to a very diversified portfolio of stocks. These products are called exchange-traded products, or ETFs for short. Like stocks, there are thousands of ETFs that you can potentially invest in, but there are really only a handful that you need to know about, and I'm going to discuss those in this video. I just did a video examining the top performing stock market index ETFs over the past 2 decades, and you can find that video up here or in the description below. In that video, I found that IJH and IWM were the 2 top performing stock market index ETFs over the past 2 decades, and those were just the 2 ETFs of the basket that I analyzed that performed the best over that period. I'm not saying those are the 2 best ETFs over that entire period. I'm just saying that of the ETFs that I looked at in that video, those 2 were the top performers over that analyzation period. IJH is the S&P Mid-Cap Stock Market ETF, which holds a basket of mid-cap US companies, and by mid-cap, that means a market valuation between $2 billion and $10 billion. So IJH is an exchange-traded fund, and that fund invests in companies that are in the US with a valuation between $2 billion and $10 billion, and the stocks in that fund cover all sectors of the US economy. IWM is the Russell 2000 Stock Market Index ETF, and the Russell 2000 Index is comprised of 2,000 US companies with a market valuation that is less than $2 billion, which means that it is a small cap company. As of this recording, 1 share of IJH is $200 and 1 share of IWM is $160. If you bought a share of IJH for $200, you would have exposure to a diversified portfolio of US stocks. Investing in mid-cap companies or market valuations between $2 billion and $10 billion is sometimes seen as the sweet spot between investing in higher risk, small companies and lower risk, large companies that are already established and likely don't have explosive growth potential. So by investing in mid-cap companies, you're getting the best of both worlds by investing in companies that have lots of potential growth, but not as much risk as investing in smaller companies, which is what you would get if you invested in something like IWM, which tracks the Russell 2000 Stock Market Index. The benefit of investing in stock market index ETFs such as IJH or IWM is that you can get access to a diversified portfolio of stocks, and you can do so with just a couple $100. And more importantly, it's going to cost you virtually nothing to hold those investments, since the annual management fees or expense ratios of these ETFs is close to 0%. If you have a high risk tolerance and a long-term investment time frame, then investing in a 100% stock portfolio by simply putting that $500 or $1,000 into a fund like IJH or IWM could be a good option. By buying and holding a broad stock portfolio such as IJH or IWM, you would essentially be following the Warren Buffett approach to investing, which is buying and holding over the long term. But you don't have to invest solely in stock market ETFs, as there are ETFs that track other markets such as the bond market. One of the most popular bond ETFs out there is TLT, and TLT invests in US Treasury bonds with more than 20 years to maturity. Since TLT's inception in 2002, TLT has earned a compound annual growth rate of 7%, and in 2019, TLT is up about 18%. As of this video, one share of TLT costs $140. An easy way to invest $1,000 in stocks and bonds would be to purchase a few shares of TLT and then a few shares of a stock market index ETF such as IJH or IWM, or any of the other stock market index ETFs that I mentioned in my other video where I analyzed the performance of various stock market ETFs over the past 2 decades. For example, buying 2 shares of IJH for a total investment value of $400 and buying 3 shares of TLT, which would be a total investment of $420, would give us an $820 investment portfolio that is effectively 50% in US stocks, particularly mid-cap US stocks, and 50% in long-term US Treasury bonds. With the remaining $180 of this $1,000 investment portfolio, we could purchase 1 share of IWM, in which case 20% of the portfolio would be exposed to small-cap US stocks, 40% of the portfolio would be exposed to mid-cap US stocks, and the remaining 40% of the portfolio would be in TLT, which is exposed to US Treasury bonds with maturities greater than 20 years out. This $1,000 portfolio would therefore be diversified across US companies of varying sizes and all sectors of the US economy, as well as US Treasury bonds. You can create any combination or weighting by using different ETFs, different share amounts, and looking at different ETFs that track different sectors. But what I'm trying to get across here is that with just $500 or $1,000, it's not a lot of money, but that doesn't mean you can't start investing in low-cost funds that give you diversified portfolio holdings. Keep in mind that when you're investing small amounts of money and buying shares of stock or buying shares of an ETF, you want to make sure that you're not paying a lot of brokerage fees, such as a ticket fee, which means you're paying $5 to $8 no matter what you do, and you're just paying that fee per trade to the brokerage firm. Fortunately, in October of 2019, essentially the entire brokerage industry went to free stock trading, which means you can buy and sell shares of stock without paying any commissions, assuming you're with popular brokerage firms or stock trading apps. There's no perfect way to investing $500 to $1,000, but in this video, I wanted to get across that even with a small sum of money, such as $500, you can efficiently invest that money by buying low-cost ETFs, in which case you're paying close to 0% in annual management fees, and you can also get a very diversified investment for just a few $100s by purchasing shares of these broad ETFs. I hope you enjoyed this video. If you did, please give it a like and leave me a comment down below, as I'd love to hear from you. My name is Chris Butler, and I will see you in the next video.